Okay, well, we are going to jump in today. We've got a lot to cover. As those who have joined us before know, we move at a pretty quick pace and we cover a lot of territory. We welcome any of your questions throughout. There's a Q&A box where you'll have an opportunity to ask questions, and we will do our best to get to those. One question that I'm going to get is, does this qualify for CPE credit? The answer is yes. You will need to attend throughout the duration, and you will need to answer the polling questions that'll be asked throughout the presentation. If you'll do that, we'll be able to issue you CPE credit through a NASBA certificate, which is accepted through the state societies or boards. We have, as I mentioned, a lot to cover today. We're going to go through a legal and tax update, hitting a number of topics, which I'm going to outline here shortly, and then turn the mic over. You've got a 6-attorney deep bench today, trying to synthesize down quite a bit of material that we're gonna summarize over this webcast. So today I'm going to hit some of the high points of what you need to have your eyes on in terms of IRS enforcement initiatives. After that, Matthew Roberts is going to provide us an update on tax fraud issues. We expect to see a lot of that, a lot of enforcement in that area in the months and years ahead. And then we're going to cover several international tax topics. One related to the IRS's new campaign, which is targeting foreign investors with U.S. real estate, FBAR penalty case updates, state and local remote seller rule updates, and then the famous McCoy case dealing with bankruptcies and tax discharges. So more to come on each of those fronts. I'm going to give you just a quick overview of some of the enforcement priorities that have not changed a lot over the last few months. So this is much of the same in terms of the IRS's enforcement focus. We continue to see kind of unprecedented focus on conservation easements, syndicated conservation easements, and charitable contributions. This is an area where we are seeing the IRS shooting for, and I've had it expressed this way to me, shooting for a 100% audit rate. Whether that is actually achievable or not, I don't know, but I have seen in correspondence with the Senate Finance Committee and with the Senate Finance Committee's public releases and recent reports in the area that the IRS is engaged in something on the order of about an 85% tax audit rate of syndicated conservation easements. We expect to see that just continue. It's one of these areas where there's an interesting amount of bipartisan support, at least from the Senate Finance Committee perspective, on ensuring that the IRS is adequately funded to go after conservation easements with a vengeance. And we expect to see that continuing. Now, another area where this really ties into is partnership audits. We expect to see over the coming year a significant increase in the number and scope of partnership audits. As many will recall, this is a result of the Bipartisan Budget Act of 2015, the BBA, which really replaced TEFRA, and is the biggest piece of tax reform that you haven't heard a lot about, but it's going to have significant ramifications. You're getting a first glimpse at a website that we actually put together. It's, I guess, as they call it, it's in the beta stages, but we're providing a link here where we have compiled really as much information as exists out there on virtually every topic related to the BBA. And so it's just a mass of information that we have been working for months on There are still a few quirks with the website, but we are rolling it out there for you here. It is also going to have an interesting forum aspect, which will allow you to register along with other tax professionals and communicate and comment on BBA related tax developments and things that we're all seeing in the field. You know, I want to point out also that we maintain, you know, on our website, a blog and podcast where we cover a lot of these topics, many of them in more depth than we are here. There are a couple of other enforcement topics that we're going to cover during this presentation, and I've got some other talented attorneys who are going to speak to those. International remains. I mean, this has been the beat for 10 years now, but it continues on. International tax enforcement remains at the top of the IRS's list, and that hasn't changed. And in fact, we have updates on that. And then one that Matthew Roberts is going to cover in a little more depth is fraud. We anticipate seeing a lot of focus on cutting down on fraud. Matt has got some updates on that front and some updates in terms of what the IRS is doing in terms of staffing up for that in the coming months. And so, Matt, with that, I will turn it over to you.
Thank you, Jason. So in recent months, the IRS, higher up officials in the IRS have been communicating pretty loudly through presentations and other sources that they intend to focus pretty heavily in the foreseeable future on tax fraud. And this is in conjunction with some new fraud hires. Earlier this year, the IRS announced that Brendan Odell would serve as the IRS's new promoter of investigations coordinator. And then only a short time thereafter, announced a former IRS CI employee, Damon Rowe, would start to serve as director of a newly created fraud enforcement office. In this capacity, Mr. Rowe is going to serve as a principal advisor and consultant to the various IRS division commissioners and deputy commissioners on all issues involving fraud enforcement, strategic planning programs, and policy. Next slide. So in the presentations, the IRS has indicated they're going to focus on kind of four areas that are really going to be at the forefront. As Jason mentioned earlier, offshore activities are always going to be high up there in the IRS's crosshairs. They continue to be so, and they will be for the foreseeable future. Employment taxes are always going to be a big issue as well, particularly pyramiding and non-payment. Cryptocurrency, fairly new one that the IRS has said they are going to devote a lot of resources towards enforcement. And then high income non-filers. And we've started to see some of that with the IRS's initiative to kind of send out revenue officers for taxpayers with high incomes that have not filed tax returns. So the key is that tax professionals need to be careful with these types of issues when they come up with their clients. If there are any indicia of fraud or there's the potential there, then it may be worth exploring the IRS's voluntary disclosure program, which we've in prior webinars kind of gone over ad nauseum. But it's an important program to kind of keep in your head as you experience clients that potentially have fraud issues. Next slide. So in all criminal and civil tax fraud cases, the burden of proof is going to be on the government. And as we know, that it's generally not the case in other issues. The taxpayer usually has the burden of proof. So this can be significant. You know, the major difference between the degree of proof required in civil and criminal cases is there's a constitutional requirement that the government present sufficient evidence to prove guilt beyond a reasonable doubt for criminal cases. And in civil cases, the government's going to have to be required to prove fraud by clear and convincing evidence. Next one. So the government has some pretty substantial penalties, civil penalties for fraud. One of them is 6663. If any part of an underpayment of tax required to be shown on return is due to fraud, and the IRS can prove that through clear and convincing evidence, then they can impose a 75% civil penalty. So stiff penalties for fraud. If a joint return has been filed, the fraud penalty generally is not going to apply to both spouses unless the government can actually show each spouse's participation in the fraud at issue. Federal courts have held that the fraud penalty under 6663 applies where the taxpayer files a fraudulent return and then tries to fix it through filing an amended return. And there are ways that you can potentially get around this, but it's important to realize that just because you file an amended return doesn't mean that it's going to erase the potential for the IRS to assert a fraud penalty later on. Next slide. So 6651F is another civil penalty for fraud. This is if a tax return has not been filed and the government can show there was an intent to evade tax. The government again can impose a 75% penalty on the tax that was required to be shown on the return. Again, the government has to show clear and convincing evidence. The fraud factors, there are a variety of factors or indicia of fraud that courts look at for both this and 6663. I won't get into those, but pretty much any relevant factor can come into play. Next slide. So the statute of limitations, as we all know, generally the IRS has 3 years to make an assessment after a return hit or an additional assessment after a return has been filed. However, if the tax or if there's any fraudulent activity, then the statute of limitations can actually be extended. I'm not going to go over this, and I will, if you need copies of these slides, I noticed we had a bunch of Q&As on it. Feel free to shoot me an email and I'll give these to you. But for purposes of time, I'm not going to really go over statute of limitations issues. So moving into criminal tax evasion, the government again has various statutes under the Internal Revenue Code that they can use. One of the more common ones is criminal tax evasion, section 7201. The government has to show willfulness, existence of a tax deficiency, and some affirmative act that constitute an evasion or attempted evasion of tax. And section 7201 offenses include filing a false return, filing a false amended return, holding property as nominees to try to avoid the government reaching to collect the tax, or concealing assets by using bank accounts of family members and coworkers. Again, methods to conceal payment of tax where it's due to the government. Next slide. Section 7202 is a willful failure to collect or pay over tax. Again, the government has to meet those requirements that are on the screen. This is commonly used for employment tax issues. So as we know, employers are required to withhold and remit employment taxes to the IRS. And if there's a willful failure to do so, then the government will commonly try to use this section 7202 to put to go after that person for criminal prosecution. Next slide. False statements, section 7206(1). This can apply, and it's pretty broad, to any return statement or other document signed under penalties of perjury. Generally, you can think of tax returns when you're thinking of this, but the government has been successful in other cases in showing other documents, which we commonly use, forms 433 for the financial information statements that we submit to the government, 656 offers and compromise, and even Schedule B interest and dividends statement where it asks at the bottom whether you had foreign financial accounts or foreign trusts. So important to keep in mind. Next slide. And that's all that I have. So I'm going to turn it over to Fernando.
Fernando, I'm going to jump in real quick and make sure we get one of our polling questions launched. So I am launching poll question number 1. How has your practice been impacted by the COVID-19 outbreak? Keep in mind for all of these questions, there's not a right or wrong answer when it comes to whether you'll receive credit or not. There is just answering and not answering. If you will please answer rather than not answer, we'll be in position to issue you credit following the webinar. So how has your practice been impacted by the COVID-19 outbreak? Significantly? Some, not at all. Got about 90% of the attendees have voted. We'll give you a few seconds more to get your votes in, and then we will move on to the next topic. Okay. Fernando, you're up.
Thank you, Jason, and nice to meet you, everyone. Today, we're going to be talking about the new target of the IRS. As you all know, the IRS usually, starts new campaigns that are focused on certain transactions or taxpayers. And in this case, it's been in the cooks of the IRS for the last, I would say, 6 years. The Treasury Inspector General for Tax Administration has been working on this issue since 2014 when they issued the first report, and then they issued a second report in 2017, and finally, this year, 2020, they issued, they released a final report on some issues that concerns foreign investors that usually invest in in U.S. real property. So today we're going to analyze, what are this new campaign is about, and how can we help your clients, to deal with this stuff in case they are not in compliance with FIRPTA. Next slide, please. So basically, as you all know, FIRPTA was enacted as part of the Foreign Investment in Real Property Tax Act of the 1980s. And basically, it is not a new tax, but rather a withholding that is done or made, on the gross price when a foreign seller sells a property, a real estate property that is located within the U.S. Obviously, the withholding must be done by the buyer, which in this case usually is a U.S. resident or U.S. tax person. Obviously, this withholding is done on any U.S. real property interest. And as we're going to see, FIRPTA not only concerns real estate property, but also real estate property that it is held by companies that exclusively have U.S. real property. So the 15% is the withholding tax rate, the withholding rate. It was before 2016, 2015. The rate was 10%, but it was increased to 15%. There's obviously the 10% rates. For example, when the property value is less than $1 million, and the purchaser, the buyer, signs an affidavit that the house is used for a primary residence. As I was mentioning before, not only involves FIRPTA, the FIRPTA withholding is not only done or applied on the sale of U.S. real property, but also in a U.S. real property holding corporation. And what is a U.S. real property holding corporation? Well, this type of corporation, it is a company or a corporation whose 50% of its assets, it is equal to the 50% of the fair market value of his U.S. real property interest and the interest in other real property that it is located outside the U.S. In simpler terms, or in other words, basically is if a company holds more than 50% in real property located within or without or outside the U.S., it's going to be considered a U.S. RPHC. What are the forms involved in these type of transactions? Where we have two forms basically, and a third form filed by the title companies or the settlement companies. The two main forms are the 8288-A, which is the tax return basic, a statement that is filed and submitted by the buyer on behalf of each foreign person to that is being withheld the amount of money. And the second is the 8288, which is basically the tax return and where the buyer reports and pays the withheld amount to the IRS. These forms must be sent to the IRS within 20 days. This is the general mechanics of FIRPTA. And as long as there is involved one foreign person, a non-resident alien, for tax purposes that it is selling this property located within the US, FIRPTA is going to apply. Next slide, please. So there's like multiple exemptions provided in the code. And one of the most popular, obviously, is when the property sales price is less than 300K and the buyer signs an affidavit stating that he or she is gonna use the property for personal purposes for at least 50% of the time in the following 12-month period. That is one of the most popular, exemptions to avoid FIRPTA withholding. There's another couple of exemptions, whether you can reduce the withholding by requesting a withholding certificate, or in this case, for example, you have to request a certificate to the IRS. Remember, the FIRPTA, as I was saying, it is not a new tax, but rather it's a withholding that is being made to prevent that the foreign resident or the non-US tax person does not escape with that amount of, of gain. So basically, you can reduce, that amount of withholding if you think that the tax that you will owe is going to be, less. So then you have to request a certificate with the IRS. There's some mechanics in there to request the certificate. But basically, this is how it works, FIRPTA. You apply the 15% rate on the gross price of the sale, and then the buyer has to report and pay that amount withheld to the IRS. Next slide. The problem here is that there's a lot of discrepancies between the amount, that it is withheld to the sellers and the amount that it is reported. Or there's another cases. There's cases where there is not even withholding applied. So basically, FIRPTA is not being, complied with. In these cases, and that's why the Treasury Inspector General for Tax Administration issued this new report in 2020, because they conducted an analysis to determine, how all these literally, little loopholes that people is like, or I wouldn't call loopholes, but rather non-compliance with the law, is causing heavy burden on the tax revenue. And for example, some of the discrepancies that the TICTA found were, for example, differences between the withholding reported on the forms 8288-A and the withholding assessed to the buyer's withholding account. Others, for example, other type of discrepancies were like they didn't even apply the FIRPTA withholding tax. And there were other cases where the withholding was applied, but it was not reported and paid to the IRS. So in all of these cases, the report basically issued a couple of recommendations that we're going to see in the next slide. Next slide, please. So what are the implications and what are these recommendations issued by the Treasury? Well, basically is we're going to clean the database of the FIRPTA, and then we're going to provide more training, obviously, for the tax examiners of the unit. But also, we're going to start examinations to these buyers that had some discrepancies between the withholding that was supposed to be reported on Form 8288 and the withholding, that was actually made to the foreign seller. And they also are going to review 1535 taxpayers that potentially received erroneous FIRPTA withholding credits when they filed, on the next year tax return. They apply the withholding and they receive a credit. So they did it wrong. So that's why they're going to be subject to examination. And obviously, they're going to, as part of the report, they're trying to create or develop a process to identify how to make it work that the 1099-S, which is the form that is used by title companies to report that a property is has been sold, it is subject to FIRPTA. So basically, these are the main recommendations issued by this report. And based on this, the IRS is going to take a couple of actions that we're going to see on the next slide. So the actions are, the first action was released on March 25 of this year, immediately after the release of the report by the Treasury. And the IRS said, like, okay, we're going to start a campaign called non-resident alien rental income from U.S. property. And they decided to go against, and review these non-resident aliens that were receiving rental income from U.S. property and that have not been reported. Has not been reported. The problem was like there was some miscommunication within the IRS, and they ended up removing this new campaign one day after the announcement of the campaign. However, because the report isn't there, FIRPTA is still a hot topic for the administration. Thereby, finally on September 14, they released the final or the second campaign, which is definite. And it is a campaign this campaign is aimed to the FIRPTA reporting compliance for non-resident aliens. And basically, this is related to FIRPTA. It must be, it is curious because this FIRPTA, this new campaign, it is not aimed properly as to examine or to analyze, the income obtained by non-resident aliens when they rent property. But rather they are more focused on the FIRPTA withholding and FIRPTA compliance based on this Treasury report. So as you can see, if there's a non-resident alien, that has applied, that did not comply, first of all, with the FIRPTA withholding, that maybe withhold less amount of money that it was due, or you have a buyer that did not report the FIRPTA, the amount of FIRPTA withheld to the foreign seller, then you're going to have issues with this new campaign. The next slide, please. So what is the impact on the taxpayers? Well, basically, you got to review the compliance of foreign sellers with FIRPTA withholding. And obviously, the first step that you need to do is obviously determine whereas they are filing, the form 1040-NR or the 11FF, which is for foreign corporations. And based on that, you can determine whereas they apply or they claim the credit for the FIRPTA withholding and in which amount they claim that credit. The second impact is that obviously, the foreign seller informed the buyer that the sale was subject to withholding. If the case is that the foreign seller did not inform, well, we have a problem there because in case the withholding is not made by the buyer becomes responsible for the amount to be withheld. So in this case, the buyer is suffering the consequences from the foreign seller for not being informed correctly. So it is relevant for them. There can be situations where there was an incorrect withholding, rather than, withholding the appropriate 15%, they just withheld 10%. In that case, well, obviously there's going to be some discrepancies. And the last one, which is once you file, the foreign seller files the appropriate tax return, 1040 or 1120 foreign, well, they are going to claim, the credit on the FIRPTA withheld. So in this case, what if they claim more credits? Well, these type of situations, they're also going to be covered by this campaign. So what we're expecting in the near future, as consequence of this new campaign released by the IRS, well, there's going to be multiple examinations where obviously the first result is going to be issuance of more deficiencies. There's going to be also assess some accuracy-related penalties, as Matt was explaining before, some civil penalties, and maybe, even some fraud penalties. Finally, what are the actions that we can do, in order to prevent all of these situations? Well, we can, obviously amend the tax return. There's some procedures to make a qualified amended tax return, a QIR. And obviously, we can make the taxpayer to join a disclosure program. Obviously, it must be done carefully. And there's also some concerns about penalty abatement, because if there's some accuracy-related penalties issued because of an improper FIRPTA withholding, well, you must request, or maybe there's an avenue for penalty abatement. And finally, probably not the best option, but also there can be an avenue for quiet disclosure, in which case, you got to be careful how you do with, or how you proceed with this disclosure. I think basically that's it for this new campaign. And I'm just gonna hand over to the next speaker, which is, I think, Ryan.
Indeed. Fernando, thanks so much for the presentation. I am going to go ahead and launch a second poll question again, so we can keep moving on progress for getting you credit. In your practice, have you come across tax fraud? Some of you may wish to plead the fifth here. Unfortunately, for CPE credit, we do need to know the answer, but we're not talking about your tax fraud. Okay, we've got about 90% of the attendees have voted so far. If you'll get those last remaining votes in, we're going to go ahead and close this poll out. Okay, Ryan, it's all yours.
Thank you, Jason. And hello, everyone. My name is Ryan Dean, and today I'm going to be going over with you some FBAR penalty case updates. Specifically, we're going to try and blow through just some basics on exactly what is an FBAR for anyone who has not really worked with them before, some potential repercussions for clients that fail to file FBARs. And finally, we'll go over a number or a few recent FBAR cases that I think are of important note. And we'll move to the next slide, please. So what is an FBAR? It really is just short for Report of Foreign Bank and Financial Accounts. So the FBAR was really a new filing requirement that was created by passage of the Bank Secrecy Act back in 1970. It created a network of required financial reporting, and it was designed to identify transactions that were possible money laundering transactions, tax evasion, and other sorts of criminal activities. However, it really has become a pretty useful tool for investigating criminal and even terrorist activity, but has really become a very useful tool for prosecutorial leverage, especially on these penalties, which is going to kind of be the main focus here. And so generally speaking, a taxpayer will need to file an FBAR if he is a US person that has a financial interest in or signature authority over one or more foreign financial accounts with an aggregate value greater than $10,000 at any time during the calendar year. And one thing to note as well is that there's actually counterpart to this FBAR filing requirement, which is a requirement to maintain records relating to foreign accounts for up to 5 years. And there can be penalties imposed for not keeping those records as well. And really the thing I want to harp on here is that the failure to file the FBAR or maintain those required records can carry some pretty steep statutory penalties. And we'll discuss those in further detail here in just a second. But again, those penalties are going to be even more significant if the IRS determines that the violation was willful. And one also other important note that the FBAR penalty actually appears in Title 31, which is not the Internal Revenue Code. So it's not generally subject to the same deficiency in collection procedures as the Internal Revenue Code. Next slide, please. And so, well, here we have the penalties for failing to file an FBAR. And so the maximum penalty for a willful violation, and we'll go into a little bit more detail as to what that means in these cases here, but the willful failure to file penalty is generally the greater of $100,000, and that's adjusted for inflation every year, or 50% of the balance in the accounts at the time of the violation. And there can even be a criminal offense with fines up to $500,000 and up to 10 years in prison. And one thing to really note here is that the penalty applies to every single year where a failure occurred. So if a taxpayer has $1 million in unreported accounts and he didn't file an FBAR for 3 years and he did it willfully, then you could potentially have a $500,000 penalty in all 3 years, which is pretty significant. There's also a penalty for non-willful violations, and this is generally up to $10,000 it's adjusted for inflation, and it's for every single violation for each year as well. And another thing to note as well is that the statute of limitations on assessing these penalties is generally 6 years. And I'm quoting here from the date of the transaction with respect to which the penalty is assessed. And that's a somewhat amorphous term, but generally speaking, the Internal Revenue Manual says that the statute of limitations will start when the report was due. So for example, an FBAR for 2018 was due on April 15th of 2019. Again, that's assuming that there is no extension filed. Then the statute of limitations for assessing these FBAR penalties would presumably run until April 15th of 2025. However, I said that that term's a little amorphous because there actually is something, there's nothing in the statute that actually says that the failure to file a report will suspend the statute of limitations, but there's nothing saying the opposite. So it's somewhat of an open-ended question right now and continues to be so. And again, the thing I want to harp on here is just how astronomical these penalties can be. And you'll see that in some of these cases here in the next couple of slides. Next slide, please. So United States versus Marcus, this is one of the more interesting recent cases. Just a quick factual summary. The defendant Marcus, he was actually a combat engineer for the US Army in Iraq, and then he eventually left the Army and ended up working for the US Corps of Engineers and actually got deployed back to Iraq. And while he was there, he actually had accepted bribes and kickbacks for confidential information related to an oil pipeline in Iraq. He ended up depositing those proceeds into bank accounts he held in Egypt and Jordan, and he did not file an FBAR reporting those foreign accounts in 2007 and 2009, but he did file an incomplete FBAR for 2008. He was ultimately convicted for bribery and kickback claims and also for failing to file an FBAR in 2009. And so on the civil side, the IRS ultimately assessed about $842,000 in willful FBAR penalties across the 3 years. And so the government eventually filed suit within 2 years of the assessment, which is essentially where this case starts. And so really the important thing to take here is that the court ultimately held that the assessments in the civil suit were within the applicable statute of limitations, and that his prior criminal conviction not involving the FBAR, so that would be 2 years 2007 and 2008, were not collaterally stopped in terms of the IRS being able to assert penalties against him after the criminal case had already been resolved. And so really the court then took a pretty close look at what evidence there was of a willful penalty assessment. And so one particular thing here is that the court cited the FBAR willful penalty again as being the greater of $100,000 or 50% of the balance of the accounts. However, there have been some previous cases, particularly US versus Colliot and US versus Wadon, which had actually capped the FBAR willful penalty to $100,000. Those previous cases, the court had essentially held that the government couldn't assess penalties over that $100,000 cap because there is actually a regulation passed that capped the penalties at $100,000. However, a bunch of courts, for example, the Court of Appeals for the Federal Circuit have disagreed with those holdings because that regulation, or excuse me, the FBAR penalty statute had since been amended, raising the penalties, and that was after this regulation had already been passed. So the court declined to follow that $100,000 cap and went really towards the statute. And with respect to the willfulness finding, it's a pretty interesting scenario. And in fact, I'm going to quote directly from the court here because I think they say it a lot better than I ever could. They said Marcus does not refute the allegations of willfulness, and we see no other way to interpret the record. In 2007, Marcus did not file an FBAR. At his plea allocution, he confessed he engaged in a criminal scheme to receive illegal bribe and kickback payments. And while he did not confess to willfully failing to file an FBAR for this year, his involvement in a much larger scheme to defraud the United States puts to rest any doubt, and Marcus does not refute any of this, that he willfully failed to file an FBAR for 2007. In 2008, he did file an FBAR, but he omitted an account from that filing, and his tax preparer has presented unrefuted evidence that Marcus never disclosed the existence of one of the accounts to him. So the only available inference from those facts is that he was aware of the reporting requirement for his other accounts, but decided not to report it. And given that Marcus pleaded guilty to willfully failing to file an FBAR for 2009, and he does not dispute it now, for each year in question, the court finds that the willfulness requirement is satisfied. So the important takeaway here from that language of the court is that the court actually was able to use inferences to justify granting summary judgment on the FBAR penalty. And I think there's a lot of practitioners out there that might ultimately disagree with that outcome, because typically courts will take a pretty painstaking analysis of a taxpayer's intent. However, here the court really just drew an inference from his criminal conviction and a few other uncontroverted facts to say, yeah, he did willfully fail to file those FBARs and ultimately upheld the penalty. Next slide, please. I'm going to blow through this one. There's a lot of facts here, but essentially this Schwartzbaum case is relating to a taxpayer who had inherited a number of foreign bank accounts from his father, or actually had been gifted those accounts from his father. He had originally talked to his CPA in 2006 about filing his return, and he brought the actual bank records with him. The CPA ultimately told him that, well, it's not likely you need to report these because they were outside of the United States and there wasn't any transactions with the United States. The CPA really did not fully understand the reporting obligations, but he did ultimately report, I believe it was either one or two of the accounts on the FBAR. For 2007 and 2009, this taxpayer ended up getting a new CPA, and he did not discuss the accounts with the new CPA. However, the taxpayer prepared his own FBARs for 2007 through 2009. Not something I would generally recommend a client to do, but he essentially copied his 2006 FBAR. And so on all 3 years, he ultimately did not file or report all of the accounts and only reported some of them. The IRS ended up assessing FBAR penalties between those 3 years for almost $14 million, an absolutely astronomical penalty in this sphere. And here again, the court actually ended up saying, well, for 2006, he did not willfully fail to file. And again, I'm going to quote from the court here because I think it's really important. Imputing constructive knowledge of filing requirements to a taxpayer simply by virtue of having signed a tax return would render the distinction between non-willful and willful violation in the FBAR context meaningless. And I say that because the government's position was, well, he signed his 2006 tax return, which includes a Schedule B, and on the Schedule B, he noted that he did not have other accounts to report. And so the government was trying to say, well, that's evidence of a willful violation, and the court ultimately disagreed. However, for the 2007 and 2009 penalties, the court said, well, he's not willful, but he was reckless. And that's a different standard than a willful violation. However, number of courts have held that reckless conduct is still going to generally be considered willful in this context. And so the court took a pretty painstaking analysis of those facts and ultimately held that, yeah, he was reckless, so those penalties will apply. There's just an ultimate, or the court ultimately held that those penalties were not properly calculated, and there's some more specific information in the slide there for you to review later, because I do want to get to this last case very quickly before we move on. Next slide, please.
All right, Ryan, let's move through this one quickly due to time constraints.
Yep. I just want to point one very quick thing here, because Matt brought it up This case just talks about the different standards the government has to prove in order to, or regarding FBAR penalties versus the fraud penalties. Essentially, the difference is the government needs to only prove willful FBAR penalties by a preponderance of the evidence, while the fraudulent failure to file penalties generally have to be proven by clear and convincing evidence, which is a slightly higher standard. And with that, I'm going to pass it on to Edward. Thank you very much.
Excellent. Thanks, Ryan. With that, I'm going to go ahead and launch our third poll question. Let's see here. All right. What is the amount of a willful FBAR penalty? This should be on point or topic. $10,000, $1 million, the greater of $100,000 adjusted for inflation, or 50% of the balance of the unreported accounts, or there is no penalty for willful FBARs, failures to report an FBAR willfully. So again, recall no right or wrong answers. There is actually a right answer to this, but for purposes of credit, we just need your answer in. Okay, we got about 90% of them in. We will go ahead and close this poll out, and we will go on to our next topic. Okay, Texas rules for remote sellers.
Hi, my name is Edward Kortz, and today I'm going to talk to you about the Texas requirements and rules for remote sellers. These rules came about because of the South Dakota v. Wayfair case, which came out, a United States Supreme Court case from 2018, and I'm sure most of y'all know about it. Prior to this case, the two big controlling Supreme Court cases were Quill Corporation and National Bellis Hess. And with those two cases, and then the myriad of cases that came after it, most courts held that, a remote seller, a seller from outside of the state that did not have a physical presence in that state, or did not have agents or solicitors actively trying to garner business in the state, or were sending agents into the state for trade shows to solicit business. If they didn't have those things, then they did not have the physical presence required for them to be to collect and report sales tax into the state. But that all changed with the South Dakota v. Wayfair decision. With that case, the Supreme Court said that out-of-state sellers don't have to have a physical presence in a taxing state for that state to require the sellers to collect and remit sales and or use tax. Next slide, please. So because of the Wayfair decision, most states now have remote seller laws on the books. There's only 4 states I know of that do not: Florida, Delaware, and Oregon. And Delaware and Oregon aren't really surprises because they don't have sales tax to begin with. Florida is a bit of surprise. And then the last state is Missouri. Missouri had legislation that was in the Missouri House, but it did not pass this year. And so Missouri is the 4th state with no remote sellers. But let's talk about Texas and the rules here for Texas specifically. So a remote seller in Texas is a out-of-state seller whose only activities in Texas are the remote solicitation of sales. And these are sales made through the internet, telephone, radio or TV, or catalog or flyers. So if you're a remote seller and you meet those types of activities, or have those types of activities that qualify as remote solicitation, then depending on your threshold of sales, you might be required to collect, remit, and report taxes to Texas. Next slide. Thank you. So the threshold amount is $500,000. So if a remote seller has Texas revenue that exceeds the $500,000, then it is required under the Texas law to get a Texas sales tax permit and begin collecting, reporting, and remitting Texas use tax to the controller. And it's required to get this sales tax permit and begin reporting and collecting the first day of the 4th month after the month in which it exceeds the $500,000 threshold. Now, if that seller, for some reason later down the line, has sales dip, then if there's a period for 12 calendar months where the sales collectively are under 500,000, it can file something with the controller, and its sales tax obligations to the state will terminate. And that's a form they can fill out if need be. If sellers are under the $500,000 mark, then they don't have, or the $500,000 threshold, excuse me, then they don't have any requirements for the state. And the third one deals with, oh, I'm sorry, next slide, please. Deals with remote sellers. And these are people that sell their products through marketplace providers such as Amazon. And as long as that marketplace provider certifies that they are collecting and reporting the sales and use tax on the remote seller's behalf, then they have no obligations to get a sales tax permit in Texas or do any kind of reporting. The only caveat I would say for your clients is that those types of marketplace sellers should keep a hold of their records for a minimum of 4 years in the off chance that they are audited by the controller. Next slide. So the other consideration is local sales tax. There's 2 ways the remote seller can do this. The preferable method is, because of its ease, is to use the single local tax rate of just 1.75%. So add that to the 6.25% for the use tax. If a remote seller wants to do this, there is a form they have to fill out and send in to the controller certifying that that's the rate they're going to use for local tax. They're not required to. If they so choose, they can also determine the local tax based off of where their product is being shipped or delivered to. But the single local tax rate is much easier. Next slide. And then after sales and use tax, the other obligation the remote seller will have is it will be the franchise tax or margin tax. And this tax, with the way the laws are written now, once a out-of-state entity or business has Texas revenues of greater than $500,000, then it is considered to have economic nexus with the state of Texas, and therefore it has to file franchise tax reports and remit franchise tax or pay franchise tax, excuse me, to the state. Next slide. Prior to that, soon after the ruling in Wayfair, the Wayfair case, the way Texas had it set was that after on January 1st, 2019, if you had the physical presence, then you had to do the franchise tax reporting, or if you got a Texas sales tax permit. And even before 2019, the only way you'd really qualify for franchise tax would be to actually have the physical presence of something or someone in the state. But with the Wayfair decision, as the way the laws are written now, then anyone over the $500,000 threshold will have to pay franchise tax. I'm sorry, I had to cut my presentation a little short, but if anyone has any questions about this, please feel free to email me and I'll be happy to talk about it with you. Thank you.
So with that, in our remaining time, we've got one last speaker who's going to present to us on some updates in the context of bankruptcy and particularly tax discharges in the bankruptcy context. Greg Mitchell.
All right, guys, I'm going to talk fast, so hang on. We're going to talk about real quick dischargeability of taxes in a bankruptcy case. When we talk about dischargeability of taxes, there are three main rules we have to deal with. There's a 3-year rule, a 2-year rule, and a 240-day rule. Next slide. Starting with the 3-year rule, taxes are generally only eligible for a discharge after they are more than 3 years old. That 3 years is determined from the time when the tax return for the year in question is filed up to the date that you file for bankruptcy. So let's say you file your 2017 tax return when it was due on April the 15th, 2018. If you file bankruptcy today in 2020, your 2017 tax debt is not dischargeable because it hasn't been more than 3 years since the day you filed that return. Now go back one year. Let's say you filed your 2016 tax return when it was due on April the 15th of 2017. If you file bankruptcy today, you are now more than 3 years separated from the filing of that return, and therefore that 2016 tax return, tax debt is now eligible for discharge. A couple of other quick points about this rule. It's important you look at the date the return was actually filed. If, for example, instead of filing your 2016 tax return on April 15th of 2017, you filed for an extension and then didn't file the return until October the 15th, 2017. In that case, if you file bankruptcy today, September of 2020, it has not been a full 3 years. Note that no payment is required for purposes of this rule, only that the returns were actually filed. Next slide, please. Next, we have a 2-year rule. The 2-year rule refers to the date your tax return was actually filed. The tax return that generated the income tax debt must have been filed at least 2 years prior to the filing of your bankruptcy petition to be eligible for discharge.
Greg, did we lose you? Well, with that, I'm going to go ahead and launch our 4th and final poll question. Here we go. How old must a tax debt be in order for it to be eligible for discharge? All right, we've got most of the votes in. Give you a few more seconds to get those last few votes in, and then we will close out the poll. Okay. Greg, you still with us? Well, I guess Greg saw we were running out of time and lost his internet connection. Are you back?
Can y'all hear me now?
Yes.
I am so sorry. So I guess I'll skip forward there. There's 3 rules, and then I was going to get into McCoy, and I'll just be real quick if that's still okay, Jason.
Absolutely.
So the McCoy case, it's out of the 5th Circuit. It's a 2012 decision. Go ahead and go a couple of slides till you get to the McCoy slide right there. The facts of this case were pretty simple. The debtor taxpayer in that case filed for bankruptcy in September of 2007, sought to discharge pre-petition income tax obligations to the state of Mississippi accruing for 98 and 99. So what happened is that after she obtained her discharge, the Mississippi State Tax Commission started trying to collect that tax. Now keep in mind, it's a fairly common misconception that a discharge order in bankruptcy somehow makes clear what debts are discharged, but unfortunately that's not the case. A discharge order is about 2 sentences long, and it basically says that a debtor has obtained a discharge of all debts that the debtor was eligible to obtain a discharge for. So then you got to go figure out what that means. So the debtor in this case filed an adversary proceeding in bankruptcy, which is basically a separate lawsuit filed in bankruptcy that's associated with a bankruptcy case, asking the bankruptcy court to determine the dischargeability of those taxes. Go ahead and next slide. And of course, so the debtor was asking the debt to be declared discharged. The Mississippi State Tax Commission, on the other hand, took the position that the debt wasn't discharged. The basis of the Mississippi State's claim is what's important. Ms. McCoy had filed the return in question late. And based on that late filing, the Mississippi State Tax Commission asserted that the filings did not qualify as, quote, returns under the bankruptcy code. So section 523A1 of the bankruptcy code provides an exception to discharge for a tax with respect to which either was not filed, and here's the key language, was filed or given after the date on which such return report or notice was last due under applicable law or under any extension, and after 2 years before the date of the filing of the petition. Note, the very last phrase is that 2-year period we just discussed. So then we look at what we call this hanging paragraph of section 523A, and it says, for purposes of this subsection, the term return means a return that satisfies the requirements of applicable non-bankruptcy law. Such term includes a return prepared pursuant to section 6020A of the Internal Revenue Code, but does not include a return made pursuant to 6020B. Most of you are probably familiar with the notion of a substitute for return. Section 6020 of the Internal Revenue Code is the provision that authorizes the IRS to prepare these. 6020A is where the IRS prepares a taxpayer's return with the taxpayer's consent and with information provided by the taxpayer. 6020B, on the other hand, is probably the kind of substitute for return that most of you are familiar with, and that's where the IRS prepares a return for a taxpayer where the taxpayer failed to do it themselves. There's no taxpayer consent, no taxpayer cooperation. Next slide. And I'm getting close, so bear with me. After looking at all these provisions, the Fifth Circuit determined that the return filed by Ms. McCoy did not qualify as a return for purposes of obtaining a discharge. And importantly, that's still where the law stands today. In the Fifth Circuit, that's the law under the First Circuit and the 10th Circuit both have their version of McCoy cases. Everyone else follows a test where the court will try and look at whether there was an honest and reasonable attempt to satisfy the requirements of the tax law. But here's the silver lining. Ever since 2010, and it has recently been updated, the IRS litigating position has been that a tax debt related to a late file return can still be discharged. So despite the existence of the McCoy decision, the IRS currently does not pursue non-dischargeability for a taxpayer, even if the return for the year in question was filed late. And the couple caveats, the taxpayer must satisfy those 3 rules that we talked about, the 3-year rule, the 2-year rule, the 240-day rule, and the tax may not have been assessed under 6020B. In other words, there couldn't have been a substitute for return filed for that taxpayer by the IRS. So a couple of takeaways that I would throw out: always file your returns on time, whether or not you can pay the tax. If you can't file your returns on time, then file for an extension and then file your return before the extension deadline. It sounds a little obvious, but then in case you don't, you should always remember that there's still hope of getting a discharge of tax. Go ahead and file the return, because the one thing you're definitely not going to get a discharge if you don't file the return. And that's all I have. And I apologize again for the brief technical difficulty.
Greg, thank you so much for sticking in there and for marching through the topic. Well, listen, we want to thank everybody for joining us today. I know you've got limited time. We want to respect that. We try to get through as much as we could and do it as quickly as we could. There will be a recording of this webinar put up on the website. Give us later in the day or tomorrow. We'll have it up under our videos section. And then we will also be emailing out certificates and PDFs of the slides and materials from today's presentation. So those will be headed your way. Again, we want to thank everybody for joining us. We will see you hopefully on next month's webinar. Thank you and have a wonderful rest of the day.